We held an online help session earlier in the week that I intended to record, but we did not record that session because of my incompetence at hitting the record button. So what I'm doing in this presentation is walking through the steps to answer 3 questions that we covered in the online help session. We covered the midnight oil multiples-based valuation, and we covered questions 3 and question 7 from the first assessment quiz. So we're going to begin with the midnight oil multiples-based valuation. We've got information to compile a valuation for the midnight oil ordinary shares using 2 different valuation multiples: the ratio of enterprise value to earnings before interest and tax, depreciation and amortization, or shortened to EBITDA. And we've got the ratios of price relative to earnings per share. We've got information for 3 forecast years for both of those companies. Importantly, even though we are using information from 3 forecast years to compile the valuations, in every instance we're doing a valuation of the shares today. Sometimes students, when they're accounting for debt, they do some projection of what they think the debt's going to be at the end of years 1, 2 and 3. And that's not what we want. What we want is estimate of the shares today and the value of the debt today, even though the valuations are based upon some projection of earnings over years 1, 2 and 3. So let's begin with, I think, the value to EBITDA multiples. So the basic idea is that there are some companies trading in the marketplace. We can estimate their enterprise values as the sum of the market value of equity and their debt. We can compute a ratio of that enterprise value relative to forecast EBITDA for years 1, 2 and 3. And we're going to assume that the market will pay the same multiple of EBITDA as an enterprise value for midnight oil. So to begin, we first have to compile value to EBITDA multiples for the comparable firms. We have a peers worksheet, and in this peers worksheet, there's data for several comparable firms. We have 13 of those. In column I, I'll highlight their enterprise value. You'll see that enterprise value is the sum of their market capitalization and their debt. In turn, market capitalization is the product of the share price and the number of shares on issue. We take the ratio of enterprise value relative to 1, 2 and 3 years forecast EBITDA. I'll highlight the forecast EBITDA in some orange shading. And if I look at the ratio of enterprise value to EBITDA, you can see that we have 5.2 for the first company with the ticker COP, 4.7 for the second company with the ticker OXY, and so on. We are going to take the median value to enterprise, value to EBITDA ratios of 5.2, 4.8 and 4.2, and we're going to use those in our valuations. The reason we're going to take a median rather than an average is because valuation multiples can take on very high levels, but they're constrained at the lower bound of 0. So they have an asymmetric distribution in the population of all valuation multiples we could observe. So if you take an average valuation multiple and apply it to the company that you're trying to value, namely midnight oil, chances are you will overstate the value of the business. So in our multiples valuation tab, I'm going to link in cell E2 to cell M15 from the peers tab. I'm going to drag that number across. We then have to estimate the EBITDA projections for midnight oil for forecast years 1, 2 and 3. And the label that I'm using for that is the income statement item for the firm being valued. So the income statement item for midnight oil. In our DCF page, we had already worked out the EBITDA projections for midnight oil. So I'm going to link to those from our DCF tab. The first projection is going to be cell E6. So we have projected that midnight oil has first year forecast EBITDA of $3.224 billion. To get enterprise value, we're going to take the multiple of value relative to EBITDA of 5.2, multiply that by the EBITDA projection to give us enterprise value of $16.871 billion. And you'll see if I drag that equation across, we have three different estimates of enterprise value, depending upon whether we're looking at 1, 2 or 3 years forecast earnings. We don't know which of those valuations is the best valuation. So we're going to take into account many different estimates of value and hopefully mitigate estimation error by taking, at the end of our analysis, an average of many different valuation estimates. The debt we have is from the peers worksheet as well. We have previously established that Midnight Oil has $5.499 billion worth of debt. And remember, it's the value of debt that we have today. So in all of my valuations here, I'm going to use an estimate of debt equal to $5.5 billion. And in fact, I can apply that to my price earnings ratios as well. To come up with equity value, we subtract enterprise value minus debt. So you can see we have three different estimates of equity value of $11.4 billion down to $9.3 billion. The number of shares we have on issue is also the number of shares on issue today. And from our peers worksheet, that number is 804 million. To get equity value per share, we then take the estimate of equity value of $11.4 billion, divide by 804 million shares on issue. And so from our multiples-based valuation using value to EBITDA, I have three estimates of equity value per share: $14.14, $14.17, and $11.60. As I mentioned earlier, I don't know which of those valuations is correct, so I'm going to take an average estimate from all three of those valuations. Now, I can take an average at this stage because having already taken median valuation multiples, I've now reduced the asymmetric distribution of those multiples. The valuations we have now take on asymmetric distribution. They're not accurate. They could be too high or too low, but there's an equal chance that any one of those numbers is too high or too low. When you have multiples, there's a better than even money chance that a multiple is too high. So secondly, we're going to look at our price earnings multiples, and the computation is going to be slightly different. The price earnings multiple, if I go to my peers tab, I can illustrate this, is the ratio of share price to the earnings per share. So you can see, for example, ConocoPhillips with the ticker COP has a share price of $54.53, and it has an earnings per share projection for forecast year 1 of $3.67. What's earnings per share? Earnings per share is the net profit after tax divided by the number of shares on issue. Technically, it's net profit after tax divided by the average shares on issue, which was in place during the year in which profit was computed. But in all of our examples, for convenience and simplicity, we are simply going to take the same number of shares and hold that constant in every forecast year. So to get earnings per share, I've previously done a computation of net profit after tax divided by average shares on issue. So the price earnings ratio is equal to $54.53, the share price, divided by earnings per share of $3.67, which is 14.8. Again, I'm going to take the median price earnings ratios, and you can see here's a good illustration of why I'm taking a median. For the company APA, which is Apache Corporation, the price earnings ratio is 525.4. That's occurred because the share price is $22.12. The earnings per share projection for the first forecast year is just 4 cents. And that's a ratio of 525. So the earnings for that company are unusually low in that first year. Maybe it's got developing resources, so they're producing low earnings today, but the market is anticipating lots of earnings growth. The share price will reflect the present value of all the future cash flows flowing to the shareholders, not just the short-term cash flows. So the price is high compared to short-term earnings. If I had taken average of the price earnings ratios, that average would have been 54 times. And if we applied a multiple of 54 times to Midnight Oil, we're going to get a very high valuation estimate. So looking at our multiples-based valuation tab, I'm going to link to my peers worksheet and take median valuation multiples of 14.8, 13.3, and then 11.8. Again, I need to find the corresponding income statement item for the firm being valued, which is Midnight Oil. So I need to estimate earnings per share for Midnight Oil for the first 3 years. We already computed in our discounted cash flow worksheet estimates of earnings before interest and tax. We use those to do our discounted cash flow valuation. But to get earnings per share, I have to work all the way down my income statement to estimate pre-tax profit, net profit after tax, and ultimately earnings per share. So let's do that. We previously in class estimated the value of the firm over an extended period. So we estimated the value of the firm, that is its enterprise value, today at $13,886 million, and we estimated future values of the firm under our projected cash flows. So you can see if I do a little graph of that, the value of the firm is going up because some money has been retained for growth. We assumed in our discounted cash flow modelling a constant percentage of debt in the weighted average cost of capital. We had previously worked out that that number was 39.6%. So to estimate the debt in each forecast year, I've taken the enterprise value times the proportion of debt within the business to project the debt over a 10-year period. That allows me to estimate interest expense. I can compute interest expense in year 1 as the amount of debt in year 0 times the interest rate on debt of 4.4%. That gives me $242 million of interest expense, and I can project that number forward over 10 years. That brings me down to pre-tax profit as earnings before interest and tax minus interest expense. And then I can estimate income tax expense. We've got a very simple assumption in our modelling that income tax expense is just pre-tax profit times the estimate of the corporate tax rate of 21%. Now, of course, in reality, the estimation of interest expense and corporate taxes can be much more complicated than that. But in our modelling, we make some simplifying assumptions to actually complete the process. In more advanced modelling, we can make more advanced assumptions, but this is what we're working with today. To get net profit after tax, we can take pre-tax profit minus income tax expense. And then to estimate earnings per share, we take net profit after tax divided by the number of shares on issue of 804 million from our peers worksheet. And that gives us estimates of 44 cents per share, 62 cents per share, and 44 cents per share over the 3 forecast years. So going to my multiples tab, I'm going to incorporate earnings per share estimates of 44 cents, 62 cents, and 44 cents. Now, when we're looking at the price earnings ratios and earnings per share, we are directly estimating equity value per share, because the profit item that we're referring to, net profit after tax, that's a profit item that's only flowing to the shareholders. The lenders already got paid via the interest expense. So we're going to take the price earnings ratio and multiply that by the earnings per share to give us an estimate of equity value per share directly. We have 3 estimates of equity value per share based upon these projections: $6.59, $8.19, and $5.25. And again, if I take an average of those valuation estimates, that number is $6.68 I don't know which of those estimates is correct. Now I could complete the table. I can fill in a couple of these blanks here. I have estimates of equity value per share in row 8. I have the number of shares on issue. And so the product of equity value per share and the number of shares on issue gives me estimates of equity value. And to estimate enterprise value, I could sum equity value and debt. Now you can see that the multiples-based estimates of the value of the shares is quite different between the price earnings multiples-based estimates, which average $6.68, and the value to EBITDA multiples-based estimates, which average 13.31. But I don't know which of those valuations is the best number. Maybe Midnight Oil has a lot more depreciation and other expenses compared to peer companies, which is decreasing the earnings per share. And maybe that's the better valuation, and maybe the value relative to EBITDA is the better valuation. I don't know. So in my valuation summary page, I'm going to take an average estimate. In my multiples-based valuation, I could simply say the average of equity value per share of $6.68 and $13.31. That average is equal to $9.99. In the valuation summary tab, if I take an average of the enterprise value from the multiples-based valuations, I have 6 different estimates of enterprise value. So I'm going to take an average of those items. That is 15,533. I can subtract the debt to give me an estimate of equity value. I have 804 shares on issue, or 804 million shares on issue. Again, I've got the same estimate of equity value per share. So in combination with my discounted cash flow valuation, and if I place equal weight on the discounted cash flow valuation and the multiples-based valuation, the estimate of equity value per share is $10.21. Now, in a real situation, you wouldn't necessarily give equal consideration to the discounted cash flow valuation and the multiples-based valuation. If you thought you had a large sample of highly comparable firms to the firm that you are looking to value, you would give more emphasis to the multiples-based valuation. If you think that the comparability of your peer companies was relatively low, you'd want to take into account more company-specific information for Midnight Oil in the discounted cash flow valuation. The second thing we covered in the help session was question 3 and question 7 from the first assessment quiz. Let's do question 3 first. So question 3 says, given some information about Borg Warner, we are going to estimate equity value per share using the free cash flow to the firm model, assuming debt of $2,100 million. So I'm going to look at the data worksheet and I'm going to work through all the steps to get our valuation. The first thing we have to do is recognise we are doing a free cash flow to the firm model. So we need a definition of free cash flow to the firm. And we had a very specific definition of that. We said we're going to start with earnings before interest and tax times 1 minus the tax rate. We were going to add in depreciation and amortization. We were going to take away capital expenditure. And we were also going to take away change in working capital. Applying that to our computations. First of all, I'm going to do a quick computation of earnings before interest and tax, just by taking earnings before interest and tax, depreciation and amortization, minus depreciation and amortization. Secondly, I'm going to multiply by EBIT times 1 minus the corporate tax rate of 21%. And then I'm going to add in the depreciation, take away capital expenditure and change in working capital via our equation after tax EBIT plus depreciation and amortization minus capital expenditure minus change in working capital. And now I have 5 estimates of free cash flow to the firm. We have to come up with a weighted average cost of capital as a discount rate now. And our equation for the weighted average cost of capital is that the weighted average cost of capital equals the cost of equity times the proportion of equity used to finance the business. Or in other words, we can write 1 minus debt to value, where value refers to enterprise value, plus the cost of debt times 1 minus the corporate tax rate times the proportion of debt to value in the capital structure. Now, we don't yet know what the leverage ratio should be. So we're going to have to make an initial guess. I'm just going to use 20% just for fun, but I could choose any number. The reason we don't know the correct debt to value ratio is we have an estimate of debt, that's 2100, but what we're trying to estimate is enterprise value, V, and we don't know that number yet, so we don't know debt to value. But there is a unique solution for the value of the business, and we're going to find that unique solution by making an initial guess as to leverage, see what leverage comes out the valuation once we've completed the process, and then we're going to make sure that the input leverage is equal to the output leverage. So I could use a bit of a label here. I'll call this input leverage. Now I can do my computation of the weighted average cost of capital. I can say cost of equity times 1 minus input leverage plus cost of debt times 1 minus the corporate tax rate times input leverage. And I've got weighted average cost of capital of 7.67%. Now, to get the enterprise value, I'm going to do the present value computation in a few steps. First of all, I'm going to do a present value of cash flows from the first 5 years. To do that, I can use my NPV equation. I can write equals NPV, open parentheses, and click on the discount rate of 7.67%, comma, and then highlight the free cash flow to the firm figures and close the parentheses. So we can say that the present value of cash flows from the first 5 years is $2,666 million. Secondly, I'm going to estimate the terminal value. This is, in other words, the value of all cash flows after year 5. Or in other words, that's the value of the business at the end of year 5. Or in other words, when it terminates, or if it terminates at the end of year 5. So because we're going to assume a constant growth rate in the cash flows of 4% after year 5, the present value of all the cash flows after year 5 is equal to the last cash flow times 1 plus the long-term growth rate divided by the weighted average cost of capital minus the growth rate. And that figure is 18,272. But we don't want 18,272. We want to know what the value of those cash flows is today. What we want is the present value of the terminal value. So I have to discount the terminal value back 5 years. Remember, it's the value at the end of year 5 at the weighted average cost of capital. So I take 18,272 and divide by 1 plus the weighted average cost of capital to the power of 5. So finally, my enterprise value is equal to the present value of cash flows from the first 5 years plus the present value of all the remaining cash flows, the present value of the terminal value. And that figure is 15,291. 1 or 2 more steps, we need equity value. So I've got to subtract the debt. The debt is 2,100, so that leaves me with equity value of 13,191. that valuation is not quite right, because I have to make sure that my output leverage, once we've completed this whole process, is the same as the input leverage going into the discount rate. The debt to value ratio at the end of this process is 2,100 million divided by 15,291, or 14%, which we could call the output leverage. Now, what we need is the input leverage from cell B23 to be the same as the output leverage of 13.73%. Right now, they're different, but we need them to be the same. We can do that very fast using goal seek. So I can have a label here, the difference between input leverage and output leverage as equal to cell B32 and B31. And then I can use goal seek to make those two numbers to be the same. So if I go to data, what if analysis, and click on goal seek, I want to set cell B33 to a value of 0 by changing the input leverage. And very quickly, the computer is going to try different assumptions for the input leverage until the input leverage gives you the same answer as the output leverage. Very quickly, the leverage is converged to 14.96%. And now I am in a position to estimate equity value per share. Equity value per share is equal to equity value of 11,937 divided by 205 shares on issue, which is $58.23. And that's the estimate of equity value per share for question 3. The final question from the help session was relating to question number 7 from the first quiz. In question number 7 on the first quiz, it says, as a standalone question, suppose the firm has projected free cash flow of $100 million in forecast year 1, long-term growth thereafter of 5%, cost of equity of 10%, cost of debt of 4%, and a corporate tax rate of 20%. The firm has debt of $800 million, and we have to estimate enterprise value of the firm. In this instance, it's a more straightforward version of question 3, because we have no explicit forecast period. The company's already in the terminal state. So we're going to say that enterprise value is next year's cash flows divided by the cost of capital minus the growth rate. So we have our equation for the weighted average cost of capital is the cost of equity times 1 minus debt to value plus the cost of debt times 1 minus the corporate tax rate times debt to value. We need an input leverage. I'll call it debt to value in the discount rate, or with our other label, the input leverage. And I might just use 20% again for fun. And now I can estimate the weighted average cost of capital. I'm going to take the cost of equity times 1 minus leverage plus the cost of debt times 1 minus the corporate tax rate times the input leverage. That's 8.64%. Enterprise value, it's the present value of the expected cash flows. We are already in a perpetual growth state, and the present value of a perpetuity, as we know from our terminal value computations, is cash flow in 1 year's time divided by the discount rate minus the growth rate. We've already got the first year cash flow of 100, and we divide that by the cost of capital minus the long-term growth rate of 5%. That gives us an enterprise value of 2,747. The debt the business has is $800 million, and that means that the debt to value ratio implied by the valuation which we could also label the output leverage, is equal to 800 million divided by 2747. That figure's 29%. Again, we need the input leverage to be the same as the output leverage. Now, we could ourselves just try different values. We could just type in 29% as the input leverage, and then type in 24%, and then 27%. And those input and output leverage are starting to converge. But we could use goal-seek to do that computation very quickly. So I could do an equation that is the difference between the input leverage and the output leverage, and I'm going to set that difference equal to 0 using goal-seek. So I'm going to click on Data, What If Analysis, goal-seek, and I'm going to set the difference between the input leverage and the output leverage to 0 by changing the input leverage. Very quickly, the difference in the leverage is going to converge to 0. And the enterprise value is $3088 million, and that's the answer to question 7. Future help sessions, hopefully the recording will work the first time if I don't stuff it up, but I hope this supplementary recording helps you in your study for our upcoming quizzes. Thank you for your attendance. I will talk to you soon.